Welcome to Ace My Exams Learning. Let us get started with today's learning.
Question. Name and explain the three main steps in developing an operating program. The development of an operating program involves three primary steps. 1. Identify the broad overall policy and direction of the government of the day. Firstly, one must identify the broad overall policy and direction. This involves analyzing official documents, speeches, and legislative priorities to understand the government's overarching policy and strategic direction. One must also consider the government's key focus areas, such as economic growth, social welfare, environmental sustainability, and national security, guiding subsequent actions. Furthermore, engaging with relevant stakeholders, including policymakers, experts, and citizens, is crucial to gain insights into the government's vision and goals. 2. Divide policy into projects. Secondly, the policy must be broken down into specific projects. For instance, if the policy goal is to enhance healthcare access, consider projects like building more clinics, improving medical infrastructure, or expanding vaccination programs. It is important that each project be evaluated using cost-benefit analysis to determine the cost and assess the benefits and risks associated with implementation, to allow resource allocation to be done based on the priority and expected outcomes of each project. 3. Schedule and synchronize. Lastly, activities must be scheduled for implementation through a detailed sequencing process that considers dependencies, deadlines, and critical milestones. Collaboration with various government departments and ministries involved in executing different aspects of the projects is vital to ensure that activities across different departments are synchronized, well coordinated, and aligned with overarching objectives. To avoid duplication of efforts. Lastly, mechanisms should be established to monitor progress, track performance, and measure outcomes, to assess whether activities are on track and adjust them as needed. Question. Explain in full accountability in relation to local government leadership. Accountability in local government leadership is a fundamental principle that ensures transparency, responsibility, and integrity in governance. Accountability in local government leadership is enforced in the following ways. 1. Supreme authority of Parliament and legislative oversight. Parliament and the legislative authority have supreme authority over both the executive and administrative bodies of government. Local governments, while autonomous within their jurisdictions, are subject to parliamentary oversight, and where required they are scrutinized for their actions and consequences imposed for misconduct, thereby fostering transparency, integrity, and public trust. 2. Accountability to elected representatives and local citizens. Local government officials are accountable to both elected representatives and residents. They must maintain transparency and responsiveness to community needs through regular communication and engagement via platforms like town hall meetings. 3. Budget as an instrument for accountability. The budget is a crucial tool for demanding accountability in local government. It allocates public funds to address local priorities and services. Officials must manage finances prudently, in line with community needs. In addition, the budgetary processes should be kept transparent to enable the evaluation of fiscal decisions and hold officials accountable. 4. Compliance with Municipal Finance Management Act, MFMA. Local governments must comply with the MFMA, which sets financial governance standards. Adherence ensures sound practices in budgeting, revenue collection, and reporting, thereby safeguarding public resources and enhancing accountability. 5. Establishment of financial systems and controls. Financial systems and controls promote transparency, accountability, and efficiency in managing public funds within local government. This includes setting clear policies, aligning budgets with priorities, implementing internal controls, providing accurate financial reporting, and conducting audits. Question. Briefly discuss the prior control principle of local government management. The prior control principle in local government management focuses on implementing control measures before actions occur. This involves setting up guidelines, regulations, and protocols in advance to ensure compliance with legal requirements and organizational objectives. This principle includes preventive measures to mitigate risks, enforcement of compliance through audits and inspections, and fostering transparency and accountability. In cases of misconduct, swift actions are taken with intervention procedures outlined. Continuous improvement is also emphasized through regular reviews and updates to enhance the effectiveness of control mechanisms over time. The prior control principle in local government management emphasizes proactive planning, regulation, and enforcement to uphold standards of conduct, promote accountability, and safeguard the interests of stakeholders within the community. Question: state the differences between capital budget and operational budget in the local municipality. The capital budget in a local municipality serves as a strategic planning tool for long-term projects. These projects typically involve significant investments and have lasting impacts on the community. Examples of capital budget expenditures include the replacement of equipment, such as vehicles or machinery, and the construction or replacement of infrastructure like pipelines. The capital budget focuses on initiatives that enhance or expand the municipality's assets and infrastructure over time, aiming to improve the quality of services provided to residents and facilitate future growth and development. On the other hand, the operational budget of a local municipality is the detailed projection of all estimated income and expenses, based on forecasts, for a given financial year. This budget covers routine costs such as salaries for municipal employees, utility bills, maintenance expenses, and other ongoing operational needs. Unlike the capital budget, which emphasizes long-term planning and investment in infrastructure, the operational budget primarily concerns the immediate financial requirements necessary to sustain the municipality's regular functions and services on a yearly basis. Question: name the 5 project prioritization classifications for capital budgets. The following project prioritization classifications can be applied for capital budgets. 1. Highest priority. These are projects that are deemed absolutely critical for the current operations or future growth of the organization. They typically align closely with the core objectives and strategic goals to address immediate needs or opportunities that have significant implications for the organization's success. 2. Essential extensions. Projects falling under this classification are necessary for maintaining the current level of operations or for complying with regulatory requirements. While they may not be as urgent as highest priority projects, they are vital for sustaining the organization's functionality and ensuring its continued viability. 3. Desirable extensions. Desirable extensions include projects that, while not essential for immediate operations, offer significant value or competitive advantage to the organization. These projects typically contribute to improving efficiency, customer satisfaction, or market positioning, thereby enhancing the overall performance and attractiveness of the organization. 4. Useful extensions. Useful extensions include projects that provide tangible benefits to the organization, although they may not be as critical or immediately impactful as those in higher priority categories. These projects often support long-term objectives, introduce new capabilities, or address emerging opportunities that contribute positively to the organization's overall objectives and competitiveness. 5. Dispensable extensions. Projects classified as dispensable extensions are those with the least priority or urgency within the capital budget. While they may have some potential benefits, these projects are typically considered non-essential or low priority in comparison to other initiatives. They may be deferred or cancelled without significant adverse effects on the organization's core operations or strategic objectives. Question: name the sources of state revenue. Sources of state revenue typically include: 1. Income taxation. This is the tax imposed on individuals' or entities' income by the government. It can be levied on various forms of income, such as wages, salaries, interest, dividends, and capital gains. 2. Property taxation. Property taxes are levied on the value of real estate or personal property owned by individuals or businesses. Local governments often rely heavily on property taxes to fund services such as education, infrastructure, and public safety. 3. Consumption taxation. Consumption taxes are imposed on goods and services consumed within a jurisdiction. This category includes sales taxes, value-added taxes, VAT, excise taxes on specific goods like alcohol, tobacco, and gasoline. 4. User charges and consumer tariffs. User charges refer to fees levied for specific government services or facilities, such as tolls for using roads, entrance fees for parks, or fees for licenses and permits. Consumer tariffs are taxes imposed on imported goods and services, which contribute to government revenue and also serve as a measure to protect domestic industries. Question. State 6 characteristics of a budget. The 6 characteristics of a budget are: 1. Enforceability. A budget is designed to be enforceable, meaning that the government or relevant authorities have the power to implement and regulate the allocation of funds as outlined in the budget document. 2. Reflects political aspirations. Budgets often mirror the political agenda and priorities of the ruling government or party. It allocates funds to areas that align with the government's promises, policies, and aspirations to gain support and achieve its objectives. 3. Incorporates sound economic principles. A well-structured budget integrates sound economic principles, such as fiscal discipline, sustainability, efficiency, and equity. It aims to optimize resource allocation, promote economic growth, and enhance overall welfare. 4. Balances political considerations. Budgets address the inherent tension between political considerations and economic realities. They strive to balance short-term political interests and long-term economic stability, ensuring that decisions are not solely driven by political convenience. 5. Reflects fiscal policy. Budgets serve as a key instrument of fiscal policy, reflecting the government's stance on taxation, spending, borrowing, and debt management. They outline how public finances will be managed to achieve macroeconomic objectives like price stability, full employment, and economic growth. 6. Hierarchy of authority. Budgets establish a clear hierarchy of authority regarding financial decision-making and resource allocation within the government. They also outline the roles and responsibilities of various governmental bodies, departments, and agencies involved in the budgetary process. Question. Discuss redistribution of wealth and focus on the South African economical context. Explain whether redistribution is an achievable reality or not. Wealth redistribution is used as a method to create a more balanced distribution of resources in society by transferring wealth and income from some individuals to others through various social mechanisms such as taxation, charitable initiatives, and social welfare programs. In the South African economic context, redistribution of wealth is a crucial issue given the stark disparities between the wealthy and the impoverished majority. Several measures have been implemented in South Africa to redistribute wealth and address economic inequality. These efforts include a range of policies and programs aimed at promoting social justice and inclusive economic growth, as explained below. First, taxation is a primary tool for redistributing wealth in South Africa. In this regard, the government has implemented progressive taxation systems to ensure that those who earn more contribute a larger proportion of their income towards public services and welfare programs. However, challenges exist in ensuring that the wealthy pay their fair share, often due to tax evasion and avoidance strategies. South Africa has also implemented various social welfare programs to alleviate poverty and address economic inequality. They include social grants, including old age pensions, child support, and disability grants, which provide financial assistance to vulnerable populations. While these initiatives have helped reduce poverty rates, they have not fully addressed the systemic issues contributing to wealth inequality. Furthermore, the government has implemented Black economic empowerment policies to promote economic transformation and address historical inequalities. These policies aim to increase the participation of Black South Africans in the economy, particularly in the private sector, through preferential procurement, equity ownership requirements, skills development programs, and employment equity targets. However, issues like elite capture, focus on the formal sector, and lack of transparency limit their effectiveness. Lastly, land reform is another tool the government has employed to address historical injustices and promote inclusive economic development. This endeavor aims to address the legacy of apartheid-era land dispossession through land restitution, redistribution, and tenure reform, to provide previously disadvantaged individuals with secure land rights while promoting agricultural development and eliminating spatial inequalities. However, challenges such as slow progress, limited resources, fragmented implementation, resistance from stakeholders, corruption, and complex socioeconomic dynamics hinder their effectiveness. Therefore, despite the above efforts, wealth inequality remains stubbornly high and requires more than redistributive policies, but also measures to promote economic empowerment, job creation, and equitable access to education and healthcare. Additionally, there is a need for renewed efforts to address issues such as corruption, tax evasion, and illicit financial flows to ensure that wealth redistribution efforts are effective and equitable. In conclusion, while South Africa has implemented measures to redistribute wealth through taxation, policy, and social welfare programs, achieving comprehensive economic justice remains a formidable challenge and requires a concerted effort by government, civil society, and the private sector to address the significant imbalance between a small minority of extremely wealthy individuals and a large population living in poverty. Question. Discuss the quid pro quo principle. The quid pro quo principle, at its core, implies a fair exchange where one party receives something in return for something given out or paid out. In a tax context, this principle suggests that taxpayers should receive measurable value or services in exchange for the taxes they pay to the government. However, in reality, the taxpayer does not receive a measurable value of collective services from the amount a unit of tax paid by him/her. This is because the services provided by government are collective in nature, such as infrastructure, public safety, education, healthcare, and social welfare programs. These services benefit society as a whole rather than individual taxpayers in direct proportion to their tax contributions. Furthermore, tax burdens are not always fair and just. People who earn high incomes pay more tax than low-income earners, yet they receive the same value of collective services. This is because of the progressive taxation systems aimed at promoting equity and social welfare. Therefore, the quid pro quo principle is limited in the context of taxation due to the collective nature of public services and the progressive distribution of tax burdens based on income levels. Question. Describe the term incentive. An incentive refers to government action to stimulate economic growth in the context of fiscal policy. Incentives can take various forms, such as tax breaks, subsidies, grants, or special exemptions to businesses in specific industries. For example, subsidies might be offered to industries involved in decentralization activities, such as moving operations to rural areas or investing in underdeveloped regions, to spur growth and job creation. Similarly, the government might offer tax breaks to exporters to encourage them to increase their overseas sales, thus boosting the economy and promoting international trade. Question. Name 4 types of wealth tax. Here are 4 types of wealth tax. 1. Estate duty. This tax is levied on the estate of a deceased person before it is distributed to heirs or beneficiaries. It is based on the total value of the deceased person's assets at the time of death. 2. Property tax. Property tax is a tax imposed on the value of real estate owned by individuals or entities. It is usually assessed by local governments and can vary based on the assessed value of the property. 3. Transfer duty. Transfer duty, also known as transfer tax or conveyance tax, is a tax imposed on the transfer of property ownership from one party to another. This tax is typically based on the value of the property being transferred. 4. Stamp duty. Stamp duty is a tax imposed on certain documents and transactions. It is often applied to legal documents such as deeds, contracts, and agreements. The amount of stamp duty owed can vary depending on the type of document and its value. Question. Explain the steps involved in the budget cycle. The budget cycle typically involves several key steps as explained below. 1. Preparation stage. The Treasury and the Department of Finance provide guidelines to government departments. These guidelines may include directives, such as a maximum limit on expenditure compared to the previous financial year. In addition, overall policy directives and priorities are communicated to the departments. The Finance Department of each government department provides a motivation report with estimates what it will cost to continue with existing activities, and the cost to initiate new projects. The operational departments submit draft budgets to their budget department, with the motivational reports for consolidation into one document. The budget department ensures the drafts comply with department policies, the executive authority directives, and the political policy of the legislature. The budget department submits the draft budget as one document to the finance minister to determine ID the draft budget meets the policy directives. 2. Approval. Once the draft budget is approved by the executive authority, it is printed and presented to Parliament by the Minister of Finance. The budget details are then communicated to the public through a speech known as the budget speech. The primary purpose of this speech is to publicly announce the various department plans on how they intend to meet the public's needs and demands for various services. After the budget is tabled in Parliament, the budget debate takes place where opposition parties have the opportunity to challenge the proposals and offer amendments. During the debate, not only are the financial aspects of the budget discussed, but policies reflected in the budget speech may also be challenged by the opposition parties. 3. Execution. Upon the conclusion of the budget debate, the Budget Act is put into effect, thereby authorizing the expenditure. At this point, the budget transforms into an operational program. In the event of excess spending, ministers may approve it, but only up to a limit of 2%. The allocated budget funds must be spent within the financial year and cannot be carried over to the following year. Funds must be spent with the approval of the accounting officer of each department, and approval of the legislature is needed if departments consider spending funds on anything other than what they were voted for. 4. Control. Controlling expenditure is a crucial component of the budget cycle, and the legislature must ensure that expenditure takes place in accordance with the wishes of Parliament and the individual taxpayer. To achieve this objective, various entities, including the Auditor General, accounting officers, and the Public Accounts Committee, are entrusted with specific powers and duties. The audit is the primary tool of control to examine financial records and ensure that all revenue and expenditures have been recorded and accounted for dutifully and accurately. There are two categories of control measures: proactive, a priori, and reactive, ex post facto. Proactive measures are implemented before any expenditure occurs, whereas reactive measures, such as audits, are conducted after expenditures have been made. Both control measures aim to ensure that expenditure aligns with the directives of the legislature and adheres to the two fundamental principles of public financial management, that is, effective and efficient use of public funds. Question. Name 4 factors that are taken into account when classifying budget information. The legislature employs 4 crucial factors to classify information and make decisions about budget allocations. These factors are: 1. Financial responsibility. The institution requiring funding must be identified and expenditure estimates should be attributed to a specific department, institution, or subsection within a department. 2. Purpose of expenditure. Each project or task should be aligned with a clear objective. Expenditure proposals should revolve around fulfilling these objectives, outlining the necessary actions to address specific needs and the anticipated benefits. 3. Expenditure items. Once the objectives are defined, it's essential to specify the goods and services required to achieve them effectively. 4. Source of financing. The origin of the funding itself, whether it's from a budget vote, a designated fund, or an account, must be clearly identified. This ensures transparency and accountability in financial management. Question. Explain the term government budgeting in full. Government budgeting is a process through which elected representatives, who act as the legislative authority, determine how to execute voters' mandate within the confines of available funds. Essentially, a budget serves as a policy document where the government outlines its proposed revenues and expenditures for the upcoming financial year. This critical document undergoes several stages. Initially presented by the government, it then undergoes scrutiny and approval by the legislature before receiving final endorsement from the President of the country. Subsequently, the Minister of Finance presents the approved budget to the nation, offering transparency regarding how public funds will be managed and allocated to meet the nation's needs and priorities. Question. State 5 aspects covered by the Resource Schedule Budget. The Resource Schedule Budget is a crucial tool in public finance management, providing a detailed breakdown of the resources allocated to various aspects of government operations. Here are 5 key aspects covered by the Resource Schedule Budget. 1. Personnel. This aspect includes budgetary allocations for salaries, wages, benefits, and other personnel-related expenses. It encompasses funding for government employees across different departments and agencies, ensuring adequate compensation for their services. 2. Administrative. The administrative aspect of the Resource Schedule Budget encompasses the costs associated with implementing organizational goals through effective administration and governance. It includes expenses related to management, supervision, coordination, and other administrative functions necessary for the smooth functioning of government operations. 3. Stores and equipment. This aspect involves budget allocations for the procurement, maintenance, and utilization of stores, materials, supplies, inventory, and equipment necessary for government activities. It includes funding for the purchase, repair, replacement, and upkeep of machinery, tools, vehicles, technology, and other tangible assets required for service delivery. 4. Land and buildings. Land and buildings represent significant assets for government entities, and the Resource Schedule Budget includes provisions for the acquisition, development, maintenance, and management of real estate properties. It encompasses expenses related to land acquisition, construction, renovation, utilities, security, and facility management to support government operations and service delivery. 5. Professional and special services. This aspect covers budgetary allocations for engaging external expertise, consultancy services, and specialized support to complement government capabilities and achieve specific objectives. It includes funding for professional services such as legal, financial, technical, advisory, and consultancy services required for project implementation, policy development, research, and other specialized functions.
To access more learning and exam preparation materials, go to www.acemyexams.coza. This link is also in the video description below. Thank you for watching this video.